Scholars once again, scholars of economics department, final year, Eco 412 advanced macroeconomic analysis or macroeconomic theory. For you to be a good economist, you must learn to have the understanding the theories. Macroeconomics is very critical for you to be a sound economist. So in this second semester of your final year is about to round up. eh, This course, I will put you through five, seven, yeah, seven topics that already I've given you the note earlier. Now, but let me quickly run down the areas I'll be concentrating in that all-encompassing note I gave you. This time, we will look at the determination of investment. Number two, the determination of marginal efficiency of capital. Number three, we'll look at the effects of monetary policy on investments, as well as fiscal policy on investments. All right. Then we'll look at the capitalist view on income, outputs, and investment, and employment, so to speak. Then the fifth item, we'll be looking at the classical and the Keynesians. You have the classical, you have the Keynesians. Keynesian view theories of employment and output. Under the classical, we'll first look at the classical theory of employment, income, and output. We'll look at the Keynesian view on employment, income, and output. Then the sixth item here, what to take a look is the theory of balance of payments. Under here, we'll do the analysis of balance of payments, outcome, the balance of trades. I'm sure you have a little of an idea of it. The balance of payment of account, the balance of payment account, so to speak. Then finally, we'll look at the theory of business cycles and forecasting. What are the phases of business cycles and economic forecasting? What are the methods of economic forecasting? So we're good to go. By the time you've done that, you've based on what your knowledge about the previous one, the first semester of my advanced macro, we'll talk about the investment function, the consumption function, production. Now, when you marry it with this one, you be able to get a good grade in advanced macroeconomic analysis equal 412. All right. So let's take you to the determination of investments. All right. Investment, inducement to invest, all right, or investment demand depends on two factors. The first factor, one expected rate of profit, which can is called marginal efficiency of capital. A person having an amount of saving has two options before him. Either he invests his savings in purchasing capital goods, that machinery, factories, and all that, or he lends his savings to others on a certain rate of interest. You agree with me? When you have when you have the savings, either you invest it or you lend it. All right? And investment in machineries, factories, or other capital goods expected to fetch him 25% rate of profit per annum, while current market rate of interest is only 15%. So it's obvious he will invest his savings on machineries and factories. So you can see he is if the his investment in machineries and factory will earn 25% per annum as against the lending interest of the people. Of course, he will have to invest in what in machineries and factories, and that's the expected profit. The profit margin is higher than that of the current market interest rate. So if investment is profitable, then the expected rate of profit must not be less than the current market of interest. If the expected rate of profit is greater than the market rate of interest, new investment will take place. Right? So investment will be undertaken in any given form of capital assets so long as expected rate of profit or marginal efficiency of capital falls to the level of the current rate of interest. Therefore, the theory of investment, I want to understand this. The theory of investment is also based on the assumption that the entrepreneur, like you and I, tries to maximize his profits. In other words, profit drives investment. That's a constant thing in investment theory. Profit maximization. So that's what we're saying here. That's what induces you to invest. You know, so profit. The second aspect of what induces one is to invest is a rate of interest. Very clear. On the two determinants of investment, induced investment, marginal investment efficiency of capital, or expected rate of profit is comparatively of greater importance than the rate of interest. This is because the rate of interest does not change much in the short run. It is more or less sticky, that is fixed in the short run, rate of interest. The changes in the expectation of profit greatly affects the marginal efficiency of capital, and make it much unstable and volatile. So as a result, in the marginal efficiency of capital, investment demand is greatly affected, which cause aggregate demand, that total expenditure, to fluctuate very much. The changes in aggregate demand, that is total expenditure. When we talk about aggregate demand, when we talk about aggregate demand, because we're talking about total expenditure. Note this: total expenditure bring about economic fluctuations, which are generally known as trade cycles. When profits expectations of business firms are good, large investment is undertaken, which causes aggregate demand to rise and bring about condition of boom and prosperity in the economy. You see, when you talk about prosperity in the economy, it's only when profit expectation of businessmen, when businessmen profit expectation are very, very good, and large investment, you now have large investment. One that large is investment brings about prosperity, the growth potential, the multiplier. The multiplier of the economy ensures that prosperity in the land. All right, and that is what we're trying. That's the total spend. So when there is profit, all right, the expectation of profits is for firms are good. It will trigger aggregate demand, that total expenditure in the economy. There will not be restriction by the entrepreneur or the businessman to invest in the economy. When you invest, that the multiplier, there's the total spending or the aggregate demand, it leads to the multiplier, the growth potential. The multiplier is the growth potentials of the economy. You invest 1 naira, in the next 5 years, you have 5 naira. So there's profit. When it has profit, so it makes the economy to prosperous. And that's the argument here. All right. So on the other hand, when expectation regarding profits are adverse, that's adverse, you know, critical, that is it's not conducive. When expectation regarding profits are adverse, the rate of investment fails. That is when there is the climate of investment is not favorable, interest rate is high, government policies and measures and all that not favorable, the expectations of profit is not is high, is adverse. It impairs investment. That's what we are trying to say. The rate of investment falls, which cause decline in aggregate demand, which cause decline in total spending, all right, and bring about depression, unemployment, and excess productive capacity in the economy as a result of under capacity utilization. So when the climate of investment is uncertain, it's adverse effects. It affects the multiplier negatively. The total spending will be reduced and there will be unemployment. When you don't spend in the economy, there's nothing to produce. Unemployment will be a current decimal. All right. And you see, when there's unemployment, there's depression, a lot of things, negative tendencies of the economy. These are things we're going to look at. The rate of interest is very, very critical and in the we want to determine investment. So let's look at the marginal efficiency, that the profit, which Keynes call marginal efficiency of capital. We just hinted it out the other time, but so the marginal efficiency of capital. The marginal efficiency of capital determined by deducting the supply price of the capital goods from the prospective yield of the capital goods during the whole life of a capital asset. You deduction. Don't you want to make profit? That's Keynes called profit in the classical theory and all that is called profit maximization or capitalist. But Keynes says it's a marginal efficiency of capital. How does Keynes put it? Keynes said it is called when you deduce the price of the capital goods from the prospective yield of the capital goods during the whole life of the capital assets. That is, you deduce the price, all right, and from the yield, you have the profit. This is total yield. What are the costs? All right, this is the return. Remove the cost. You need the profit. That one, you now get the profit. But Keynes will call it the marginal efficiency of capital. All right, and is shown. So Keynes define marginal efficiency of capital as being equal to the rate of the discount, which would make the net present value (NPV), all right, of the series of annuities given by the return expected from the capital assets during its life just equal to the supply price. So, according to Keynes, marginal efficiency of capital is the rate of discount which renders the prospective yield from a capital asset over its whole life period equal to the supply period of the asset. A rate of discount. Remember, he said is the rate of discount which renders the prospective yields from a capital asset over its whole period equal to the supply price of the asset. So this is the MEC. MEC is one of marginal efficiency of capital. You can see the formula. Supply price is equal to discounted price rate C over R1 plus Y plus R. This is the supply side, all right, plus C. This will tell you about the scenario over a period. When you say C R1, R2, R3, R4, and Rn, that's ad infinitum. When you see this the formula as R is equal to over 1 plus R plus R2 1 plus R square, then plus R3 1 plus RQ plus Rn over 1 plus Rn. That's ad infinitum. So what it means in the fact is that where C is the supply price, all right? The C is supply price or replacement cost. You get the point? Then R1, R2, R3 represent the annual prospective yields. Annual, every year. That's why prospective yield. This is the cost and the yield. The difference of that is the marginal efficiency of capital. So R1, R2, Arrow 3, arrow 4, and tells you the annual. So this is year 1, arrow 1. This is year 2, year 3, year 4, not year end. That means year 3 is ad infinitum. That's why when you put that end. All right. So represent the annual percentage yield from the capital asset. I is the constant. If you look at it, and arrow is the rate, is that rate of discount which renders the annual prospective use equal to the supply. Discounted rate. Arrow is that rate of discount which renders the annual prospective use equal to the supply price of the capital asset. For example, look at it. All right, are you there now? C is equal to arrow 1 over I plus R plus arrow 2 over 1 I plus arrow square. When you say now, if 300, that's we are talking about the C now. Let's the cost of is the cost of the supply of price. All right, are you following me now? Or replacement, that replacement cost. Then if 300 naira, for instance, there, that is the cost of the surprise. I don't want to get the money of capital, MEC, that's the profit. If we have the 300 and we see that what are the annual prospective yields is equal to 1,100 and all right 100 over 1 I plus R plus that is for R1. For R2 will give you 2,400. These are annual prospective yields. All right, will give you this. Then after the calculation, am I communicating? Then R is 10%. Therefore, by substituting R in the formula, we have, look at it. We have 300, because this is a subtraction effect now. 300 is equal to 1,100 over, all right, 1.1. That's 10% interest rate. All right, 10%, 10%. That will be calculating. R is the 10%, therefore, by substituting. You are substituting 10% in by R. So where you see R, you put 10. All right, that's what we're saying now. I plus 10 plus I plus 10 square, because this is for the second year of the. So when you calculate it, it will be giving you 3,000. All right, you know you are what to call simultaneous equation, substitution effect. You have done your substitution with your substitution effect. You're able to know this. I don't need to tell you about substitution effects. If you know, it's something. No, that it's something you have to know. It's not something that you will I have to teach you right now. And so when it says it will give you 3,000, which is equal to 1,000 for the year 1 plus 2,000 for the year 2. This is what you have to know about when you want to calculate the determination of marginal efficiency of capital. All right. So in effect, you have to don't get yourself bothered about this mathematical economy. It's just trying to tell you, because it's a linear equation. We have maintained a straight line. It's a straight line equation. I know some of this new in thinking economy is being challenged. Like for me, the book I'm writing now has questioned some of this linear equation. The world now is going secular with climate change and all that has begun to question some of these theories. But then, as an economist, not questioning. You are questioning in order to adjust it. So we have a new thinking about our adjustment. It's from linear to secular. Yeah, so secular economy. So linear equation to secular, and maybe with time I'll be able to, when we finish this course, I'll be able to tell you where the new narrative, the new thinking is going. But for now, this is the economic theory on marginal efficiency of capital. That's the Keynesian view of profits, under macroeconomic thinking. Yeah, good. Now let's look at the effects Yes, let's look at effects. Yeah, all right, the effects of money. That is the third item here right now. Let's look at the effects. Let's look at the effects. Let's look at the effects of. Let's look at the effects of um, the effects of monetary policy on investments. All right, and fiscal policy on investment. I have told you ab initio that in our last semester, during your first semester, you have the details of what monetary policy and fiscal policy is all about. No, but here we cannot begin to look at its effect, its application, its effects on investment. At least you can. If I ask you that question, you'll be able to answer me. What are the effects of monetary government spending and taxation on investment? That fiscal policy, government spending and taxation. When we talk about fiscal policy, like I told you last semester, what are the effects of government spending, fiscal policy, government spending on taxation to inflate economic outcome? Also, what are also the effects other monetary policy? What are the effects of government monetary policy? The supply of money in the economy. All right, but let's just look at it now, based on this application of these two policies on investment. Then that's why most of your thinking now, you must learn to be an analyst, a forecaster. You begin to be an analytical thinker. And that's why at any point in time, beyond what we teach you in the classroom or this online, you must learn to develop. I give credit to the immediate past, those who graduated now, Carlo and Co. in the class. They were excellent. Sometimes I'll give them analytical questions and they'll answer and we'll review it. So you must be, as a will good thinkers, those Carlo and Co. in the last semester, he had first class, we had two first class there and all that, some class upper. So you people must be be their final year scholars. So you must be an analytical thinker. So let's look at the effect of monetary policy on investment. In our statement here, monetary policy and discretionary fiscal policy affects investment. That first statement you must make. As an analyst, it affects investment. Again, ask us how. So we know already that interest rate measure the cost of capital, and along with the marginal efficiency of capital, that profit determine the level of investment. So it is primarily through its effects on interest rates that monetary policy affects investment. So besides interest rates, investments also depends on the availability of funds. Are you following me? So you can see interest rate is very critical on investment. So another determinant of investment is what? Availability of what? Of funds. Do you agree with that? Or credits, right? Especially from the bank. That's why the funds are very critical. Besides interest rates, if the funds are not there, interest rates will be useless. And that's why the more the funds, the lower the interest rates. But when there's a liquidity squeeze, that's a scarcity of funds, interest rate shows up. That law of demand tells it. So the easy monetary policy, which aims at lowering interest rates and increasing the availability of credit, will lead to more investment. That's what I've said now. With lower interest rates, increasing the ability of credit will bring in more investment because people now go and borrow at low interest rate. So it increases investment. So under easy monetary policy, the central bank lowers the bank rates and cash reserve ratio. I've told you about last time. Lowering of the bank rates sends signal to the banks to reduce their lending rates. So also lowering the cash reserve ratio, CRR, leads to more liquidity. So when the CBN, which is the coordinating bank, the central bank coordinates the commercial bank, discount banks, and all that. When they lower the reserve ratio, it puts more money in the if the reserve ratio is 20% in the banks, that the ratio is what the rate at which banks must be here. If CBN right to lower it by 10%, there's more liquidity in the bank. It makes the commercial banks much will have more money in that's the way the CBN does to regulate the monetary supply and the inflation and all that. So when you increase the reserve ratio or reduce it. So when they lower the reserve ratio, that's what it said here, and bank rate and cash reserve ratio. Lowering the bank rate sends signal to the bank to reduce their lending rates. That's from 25% to 10%. Also, lowering the cash reserve ratio leads to more liquidity or extra cash reserves with banks. So the reserve ratio, when CBN lowers it by 10%, if it was 20% before, when it lowers by 10%, there's another 10% money in the bank. So it increases the liquidity of the commercial banks. All right. Uh, so and once it increases liquidity, it gives them more money to invest. All right. These are so 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 yeah. This not only increases the availability of more credits for investment by businessmen, but also put downward measure or pressure on lending rate interest rates as a result of increase in the supply of loanable funds with the commercial banks. That's what I've just explained now. So by lowering the cash reserve ratio, the central bank is making a statement that commercial bank, you have enough money. Like I said, the reserve ratio used to be 20%. Okay, because they want to supply, it makes sure that more money investors are encouraged to invest in the economy. The lower the card is the amount of money percentage withhold by commercial banks, being coordinated by banks. So if the CBN it said I want to lower it by from 20% to 20% to 10%, it then means that there will be more money. That extra 10%, more money to it be available for commercial banks to trade, to invest. That's we call it loanable funds for investment. All right. So the reserve ratio is very critical, and the bank rate very critical in investment. And of course, it's determined by what the monetary policy now, that is the CBN now regulating them. So at a lower interest rate, given the schedule of marginal efficiency of capital, more investments will be undertaken by business firms. You can imagine lower reserve ratio, more investments will be undertaken by business. Central bank can also undertake open market operation (OMO), open market operation to increase the availability of bank credits for investment. For example, when it buys securities from the banks and pay cash and fund to the banks. The central bank can also buy securities from banks. In the essence, it puts exchange cash to the banks, increasing the liquidity of the various banks, commercial banks, of this kind of banks, as the case may be. All right. For example, it buys securities from the bank and pays cash or funds to the bank. This exercise raises money supply in the economy, which will not only make more funds available for lending to businessmen, but also leads to lower interest rate. So that's what. The moment in order to increase the money supply in the economy through open market operation, all right, the central bank does what? Buy these securities from the commercial banks and the banks. In exchange of cash, they give them cash. The essence is, this commercial bank take this cash to lend to investors. And by so we are increasing money supply in the economy. Investment are also going on. But when it is expected there is inflation, the money is not being channeled into production. The general is not so that's inflation. Why into consumption? What the central bank will come with another policy too. You have to do what? Sell securities sell these securities to the commercial bank and withdraw this money and withdraw the money in circulation. So that's the way. At any point, when they notice that the economy is not the economy is is becoming inflationary, is there too much money in the economy, and as against not much goods, they begin to sell securities to these commercial banks, and in the process they try to mop up this liquidity. So these are one of the, but the one that is in a bid to encourage production, the central bank, and so as to ensure that banks lend this money to the investors, the genuine investors. They will do what? They sell securities. They buy, they sell securities from, buy securities from the commercial banks, and in exchange give them cash. And this commercial bank will use this cash as loanable funds to prospective investors, and that lets the money supply investment will grow. These are things we should need to look at within the monetary aspects. We are looking at the monetary point of view of investment. All right. So I have told you how it works on monetary point. Then the fiscal point, that's the total and investment. The fiscal point here, we're talking about government spending and taxation. So what is the effect of fiscal policy and investment? I said it's a common knowledge that there's an adverse effect of expansionary fiscal policy on private investment. Through increase in government spending financed by borrowing will lead to increase in aggregate demand, that total expenditure from goods and services. It will raise interest rates. Borrowing by government will raise the demand for loanable funds, and money in the market will, which given the supply of money will cause interest rate to rise. So you get the point. He said borrowing by government will raise the demand for loanable funds, all right, and money in the market will, which given the supply of money will cause interest rate to rise. So the high interest rates will lower investments, which is true. The high interest rate will lower investments. So yeah, we're talking about government spending. When government borrows money, there will be a challenge. It lead to a rise in higher, cause a rise in interest rate. So the high interest rate will lower investment. Thus, expansionary fiscal policy crowds out private investment in the loadable fund market. Doesn't encourage private investment. It's a very, especially fiscal policy crowd out private investment in a loanable fund market. Another way through which adverse effects, all right, adverse effects affects uh, effect on the expansionary fiscal policy is brought about is that the increase in aggregate demand, that total spending, as a result of expansionary fiscal policy in terms of either increase in government expenditure or cut in taxes, will raise aggregate demand and leads to increase in national income. Yeah, this is true. This is true. Look at it. Another effect of expansionary fiscal policy on investment, yeah, yeah, as a result of it's in terms of either increase in government expenditure when government spends more money, or cut in taxes when there is cut in taxes. There's so much money in the income. Look at the effect when government spends money. Yeah, yeah, it releases money. That's money at home. They cut in taxes. What would that do? It will raise aggregate demand and that total expenditure and leads to increase in national income. That's it. When there is government expansionary fiscal policy and government spending, all right, there's so much money government spending. There's so much money because in fiscal policy it's either government spending and taxation. So let's do through the scenario now leads to increase in national income. Now, when government spends more money in the multiplier, the money enters in the economy. Many people will have much more money. It leads to increase in national income because it leads to the multiplier. The multiplier I told you of. When government spends 1 billion naira in the economy, in a productive sector, remember it must be not in consumption, in a productive sector, the multiplier, that the growth potentials of the economy, that's the multiplier. If appropriately if the money is spent appropriately, it will lead to a rise in national income by maybe 500% or 400% in the next 5 years, from 1 billion to 5 billion. All right, that government is spending. Then another way of expansionary fiscal policy also, government might decide to cut taxation. When you cut taxation, you have left much more money, all right, in the hands of the people. The government will spend, and the spending will grow the economy. So the national income it rises. So when you cut taxation, you are leaving much more money in the hands of people. It grows the national income as well. Unlike when you rise taxation, when you increase taxation, assuming I used to pay, I'm a salary earner of, I earn 200,000 naira. All right, and I pay annual tax of 30,000. No, 300,000, 10% of my earnings, that's 30,000 naira. Then government now decide to to cut taxation by 50%. So what I pay 30,000. So in 2023, by 2022, but by 2023, instead of paying government policy of cutting tax, all right, by 50% taxation, I will now pay 15 naira instead of the 30 naira. Mark you, my income is 300 naira. I'm giving an instance. Okay, let's say 300,000 a month. Then I pay a tax monthly payment of 10%, which is what 30,000. All right. So by so doing, government has said, okay, this tax is too much. Let's cut down the taxation, the tax by 50%. 50% of 30% is 15,000 naira. So I now by 2023 I'll pay 15,000 tax. So I'll be having much money, extra 15,000 in the economy. So it's going to increase the national income. All right. So that is what it tells you, that by the time the kind of thing you will see here in terms of investment, when government spends more money, it grows the economy. When government cuts taxation, it also grows the economy. But you have much more money for individual to hold, or even the private companies. Even I'm talking as a private individual. Those personal income taxes. What about the company taxes and all that? When there's a reduction in tax, it makes more companies to now have more money to invest. Other this money would have gone to the bank in form of taxation, to the government in form of taxation. These are these are where we look at. However, the increase in national income brought about by increase in aggregate expenditure, that total expenditure, will bring about increase in transaction demand, exchange for money, which will cause interest rate to rise and lower the private rate. So it will lead to transactional demand. So for money, transactional activities, it depends on what you are using, what you are transacting, using that money to transact. And if you use that money to transact and consumption goods, that's dangerous. And that's why move into production. Production is very critical. Once you have into the productive sector, and with a favorable interest rate, I mean, it helps to grow the economy. But when you go to transactionary and it becomes inflationary, you know, it depends on the nature of goods what are you transacting? Are you into transacting consumption goods or productive goods? It depends. That's why, but in other words, so the point I'm trying to make here is that um, yeah, is that the increase in national income will bring about increase in aggregate demand. That total expenditure will bring about increase in transaction demand for money, which will cause interest rates to rise and lowers private investment. So that kind of too much money, transaction demand, that too much money, and that's it, and it lowers the private investment. So interest rate at any point in time that a rise in interest rate, it affects investment, because the implication is that the investors will not have money, will not have if the interest rate is high, the interest the, and the climate is not friendly. the investors will not be able to go to borrow money, the loanable fund for investment, and it's dangerous for the economy. So those are things to be looking at. Both the fiscal policy, and that's why the government are managers. This policy, monetary policy and fiscal policy are very critical. You need to manage the economy. Like I said, the economy is like a spiral. The economy is not a laboratory where you have a microscope. You have a predetermined outcome. But here, with facts and figures available, we make our projections, scenarios. All right? You see, we are doing our forecasting now. From forecasting, we are doing foresighting now. It's a new knowledge. In my forthcoming book, you see some of this new knowledge or new thinking. So you forecast based on what you have seen, based on fiscal and monetary policy, you make your analysis, informed decision. So that's it for policy. So then let's look at fiscal policy that may affect investments. I want you to know this. But from all we have said, these are the fiscal policy that may affect investment. One, government borrowing. Government may borrow. It makes interest to high, and that's what I've said here in a nutshell. So it's very important when government borrows and borrows, and once they borrow and they don't put it in productive use, it is inflationary. Government will borrow money and put into consumption. Government will borrow money and put into general administration. It will not, once the money enters into the economy, it becomes inflationary, and then price rises, interest rate rises, it will affect investments. Ask your various governments, to what extent when you borrow money, where do you put it into? That's why there's a call now for production, production, production. When you borrow money, put it into the productive route. The investment in production will grow the economy, because the production, as you put it in agriculture, people will be employed. And once they employ people in agriculture, they earn a living. And then they earn a living, they earn income. And that income, they spend that income in the economy to buy other goods, to buy tomato, buy goods, buy bread, buy other things. And those things, those people they buy the money, those people now earn income, and that money they earn will also they spend it in buying machine, buying cars. That is how grows the economy. That's called a multiplier. They multiply the growth potential. When you invest in agriculture, it has positive multiplier effect. So borrowing knows what? Then cutting taxes positively. So when government borrow, it affects investment in a positive way. Is when you put it in productive use, it grows the economy. But where the developing nations have failed, I'm sorry to say it, that when they borrow, they put it into sectors, they use it to they share it among themselves. That's what's the corruption. They share it among themselves. They don't put it in something that will grow the economy. They put it in consumption. That's why we are here today. Government, when you cut taxes, it also affects investment positively too. Because when you cut taxes, the companies that are ordinarily paying millions, assuming the company is paying Dangote is paying 500 million naira or 1 billion annually. Let me give an instance for tax for Dangote Group. Suddenly, the government decide to pay that 1 billion. Okay, we have to cut that tax by 50%. Then you know what? He paying 500 million the next year. He used the tax cut, the other 500 million to further invest in the economy. So that's the essence of tax cut. The way people say, the taxes are high. When people say, try and make sure you cut down. When government embarks on the policy of cutting down taxes, that fiscal policy of cutting down taxes, it helps to grow the economy positively. Because there'll be more money and it's part of both the personal income or the company tax, as the case may be, you use it to invest in the economy. Investment tax rebate or relief, that's not the tax relief. The government might say tax holiday. That's why most of the big time companies, the tax holiday or tax relief, in a bid to attract foreign direct investment. Government might say, okay, we'll give you tax relief or tax holiday. For what? For maybe 1 or 2 years. Come and invest in this country. For 4 years, you will not pay tax. All right, we'll call it tax relief or tax rebate, as the case may be, or tax credit, and stay with all of them are called tax holiday. So just for 4 or 5 years, come and stay, but after 5 years, you start paying tax. That thing is an attraction for investors, right? So when government doesn't do this, when they don't do this, it affects investment negatively. But what they do, when they cut tax, it affects. When they do all this, it affects investment positively. When they don't do it, or rather when they increase taxation, it affects investment negatively. When government refuses to borrow, in the face of, that's why borrowing is not a bad phenomenon in the economy. Just listen. Even you as an individual, when you borrow and invest it appropriately, and then you'll be able to pay back. Give us when you pay back, and you have that. Look, America is the greatest borrower, the greatest country, the worst in terms of trillions, and they have borrowed trillions and trillions of dollars. But you know why? Why they are not bothered? Because they are credit worthy. Their reserve, their foreign reserve is, when they want, they can pay it immediately. So that is their debt profile. Sorry, but they are credit worthy. When a country is credit worthy, you can pay your debt immediately. But Nigeria and some of the developing countries are borrowers. They are not credit worthy. When you look at their debt, when you look at their foreign reserves, they have eat up. If you see, I don't want to sound pessimistic, because Nigerian government are noted for profligacy, sharing money that belong to the common patrimony, taking money from your foreign reserve instead of saving. Saving culture helps you to be on the side of a credit-worthy nation. Okay, so these are things to begin look at in the investment scenario. Tax credit, I give you credit. When I give you credit, that means don't pay. Begin to do things for 2 3 years. After 2 years, that credit you pay back. These are things that can affect investment. On the monetary side of it, I've told you interest rate through bank rates. Yes, if it's low, it increases investment. The cash reserve ratio of the CBN, if the CBN decide to the reserve ratio CBN keeps in all the banks, commercial bank, if it might be 10% this year, the assuming is 20% reserve. This money, don't touch it. It is the percentage of your total income or your total reserve. Don't touch this 20%. That's the CBN directive. No matter the amount of money banks have, there's a special amount. It's still we call it the reserve ratio. It's equal 20%. The CBN might say, okay, because I've seen that the liquidity is not. You guys will have a liquidity scarcity of money. CBN must, okay, from that 20%, we're going to reduce by 10%. Banks will clap. When you say 20%, 10% now, what it means that they have another, assuming this reserve ratio is, let's say 2 billion. This 20%, let me put in the figure now, is 2 billion. And CBN sees that the economy is not progressing. It's how we're having a dwindling economy, or there's not much money in the economy. Okay, he now lowered the reserve ratio from the banks to what? 10%. What means that instead of 2 billion, he now relies with 10%. That's what 10%. That's 1 billion. The banks have excess of another 1 billion in the account, so they can use that amount for loadable fund. They will be so happy. So that's what the bank does. That's what the CBN does to checkmate the economy. Through commercial banks. Of course, then the bank rates in terms of interest rate and all that is very critical. The open market operation, when the CBN want to ensure to release money into the economy, they buy securities from the banks. In exchange of these securities and bonds, they give the bank money in terms of cash, the exchange of the securities, and that cash, the commercial bank uses it as loanable fund to investors. So, my dear scholars, except the rate of interest, like the marginal efficiency of capital, it is the rate at which a rate which equates the supply of price of capital assets to its prospective yield. The investment on an asset will be made depending on the interest rate involved in getting the funds from the market. If the rate of interest is higher, investment is at a lower level. A lower rate of interest leads to an increase in investment. Thus, the marginal efficiency of investment relates the investment to the rate of investment. All right? This is for this. I'm closing up for this model. If you have seen, I have discussed the determination of investment, the determination of marginal efficiency of investment of capital, and as well as effects of monetary policies on investments and fiscal policy in investment in this our course. So I want you to take time to go through this. Ask me question if you, for clarification in our WhatsApp chat. All right. So that's the end for this model. I remain your lecturer, Professor Magnus Onoha. Thank you so much, and let's continue to interact and build knowledge. Right.